Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. This is host Richard Benuli. Today is September 19th, and we have returning guest Charles Hugh Smith. Charles is author, leading global finance blogger, and America's philosopher, we call him. He's the author of several books on our economy and society, including some of his books are titled A Radically Beneficial World, Automation, Technology, and Creating Jobs for All. And there's also Resistance, Revolution, Liberation, a model for a positive change. And another one, The Nearly Free University and the Emerging Economy. And another one, Pathfinding Our Destiny, Preventing the Final Fall of Our Democratic Republic. And Will You Be Richer or Poorer? Another book. And another recent book, Global Crisis, National Renewal, a revolutionary grand strategy for the United States. His blog of twominds.com is one of CNBC's top alternative finance sites, and he's recently launched his Substack, which is very successful. Welcome, Charles.
Thank you very much, Richard. And I have to say, you can tell from all those books, I just can't stop myself. So
yeah, exactly.
Well, I'm looking forward to our topic today, which is going to be pretty wide-ranging. And you asked me to start with a post I wrote earlier in the month on the topic of, is the everything bubble about to pop? And the idea here was to look at the extreme valuations in, say, real estate and equities and compare that with previous overvaluation periods, and also look at some of the dynamics underneath these bubbles. For example, the extreme concentration of wealth in the top 10%, at least in the United States, and I believe that can actually be claimed globally. So that the wealth of these created by these asset bubbles is dominantly in the top tier of the population. So we have extreme wealth and income inequality. And I kind of touched on some of the key drivers of this everything bubble. One of which, of course, is just the expansion of the money supply and credit. And that we call this like liquidity. But whatever the term is, the wealthy who already own the assets that are rising in value, they have access to credit because, of course, they have the collateral and they have the income. And then those, the bottom 80% who didn't buy the assets when they were cheap and don't have the same income, they can't really borrow enough to snap up, compete for all these bubbling assets. And so they're like left out because they're relying on wages, which have stagnated for roughly 45 years. So the sort of net result of what we can sort of summarize as financialization, liquidity, credit, and globalization, which is the benefits of capital flowing effortlessly digitally to the detriment really of wages, which, as I said, have stagnated for 45 years. So if you put all this stuff together, you end up with a lot of new money and credit chasing real world assets. And so this is why we have a bubble in equities and real estate particularly. So where does this go? And you and I, before we started recording, were discussing two possibilities, which are pretty self-explanatory. One is the air goes out of these extraordinary asset bubbles and they decline. And the examples include the dot-com bubble in 2001 and 2, the great global financial crisis in 2008 and 2009, and where these markets declined by 30 or 40%. And in the case of the dot-com era, they actually declined about 80% in the NASDAQ. So you could have that kind of deflation, but as you were explaining to me, there's a lot of systemic incentives to keep equities and real estate high, their current valuations because of various factors. And maybe you can go into why there's so much pressure to keep equities and real estate, overvalued.
Yeah. And I mean, we have the situation in the economy now that there's a strong dependency to elevated asset valuations, whether that means on the equity stock markets, for stocks to stay elevated, or for housing prices to stay elevated. And why is that? So I think some of the reasons have to do with psychologically, if people see their stock portfolio going higher, they're likely to spend more, on going out to restaurants and just, various discretionary type spending. And but if it goes in the reverse direction, they're more likely, even though they haven't, sold anything, they haven't maybe sold any stocks or taking profit or losses or whatever, they just don't feel comfortable as spending as much, right? So it's sort of a psychological effect, partly, and also partly in real terms, right? Because if you have some sold stocks, you have some equity or cash to spend, and the same thing in the housing market as well. Same idea, but it's also a bit more than that, because if housing prices were to go down, banks might be in trouble, or governments that have provided insurance, like they do in Canada, to the banks for homeowners to take out loans. Basically, they just don't want the homeowner to mail in the keys and default, right, on houses. The whole system is reliant on the homeowner still paying mortgages, and the banks collecting mortgages. And so, it relies on that sort of elevation of asset prices for that. The minute asset prices come down, housing prices, there's less of an incentive for the homeowner to keep the house. And there's even some differences, like between U.S. and Canada, recourse loans, and in terms of liability, it's actually stronger, worse in Canada than it is in the U.S. But yeah, so that's basically the idea, Charles. And so why is it that they need to keep those prices elevated? Those are some of the reasons. And what we're talking about is nominal. So you had your article here. Does anyone else smell a market crash in the air? Yes, the answer could, the market crash. But the big question is, how does that manifest itself? Is it going to be in nominal terms, or is it going to be in real terms, or maybe a combination of both? Your thoughts, Charles?
Right. And that's one of the key topics that we want to explicate today is the difference between a decline of, say, 60%, a significant decline in real terms versus nominal. So that's why we both explored the 1970s equity markets as an example of how this works. And so you had posted a great article on Cedar Owl, and I'd posted earlier articles where I used a similar chart to what you've posted, which shows that equities went up and down and in a considerable range in the 70s, in that decade, from basically 15 years, from 1966 to 1982. And so nominally, you could look at this chart and go, well, the Dow topped out at 1,000 in 1966 or 69, whatever. And then, it went back to 1,000 in 1982. So everyone was whole, right? Everyone got their money back. But if you include inflation, the decline in the purchasing power of the currency, everybody lost like 2/3 of their money. And so, as you explained in your article, the difference here is that um, those equities that were yielding a dividend sort of saved the people who owned that portfolio, as opposed to the people who just owned equities that had no dividend or trivial dividends. Then they actually lost a lot of purchasing power. And so they weren't whole when the Dow went back to 1,000. They'd lost like 2/3 of their capital. So that's the danger. And of course, as you explained, Richard, there's institutional and central bank incentives to go ahead and inflate away our capital as a means of kind of keeping everything kind of glued together. So, and you gave an excellent example of how nominal and real works in terms of purchasing power. And maybe I can ask you to repeat the story about pricing houses in like cups of coffee.
Yeah, and to help understand that the difference between real value and nominal value, real value being nominal value minus the inflation rate. But yeah, a good example is actually what has happened and is happening in the home price area in many jurisdictions across North America. Not all, but in many. So and it's likely actually to go continue in that trend. And namely, the example is like in some areas, especially in the Toronto area. As one example, you've got houses mostly in the $1 million Canadian range or higher. And so let's say if you take a price of $1 million house and you divide by how many cups of coffee, Starbucks coffee, or maybe Subway tokens, how much you can buy with that. And, maybe it's about 300,000, let's say, of cups of coffee you can buy today, or tokens for Subway you can buy today. And now if you fast forward, this has already been happening, but if you fast forward into the future, like say 5 years or 10 years, maybe the price of that house goes up to 1.2 million or 1.5 million. And so you think, wow, I made 200,000. Wow, I made 500,000. Yes, in nominal terms, but in real terms, maybe that 1.2 million or 1.5 million only is able to buy 250,000 cups of coffee, or maybe even 200,000 cups of coffee. So you've lost wealth. You've actually lost real wealth. And this has already been happening in the housing market in many jurisdictions. Many people don't realize it, but nonetheless, that's how. But everything is still intact, right? The banks are still getting paid their mortgage. People are not walking away. People are still holding houses, but overall wealth and standard of living going lower. What your thoughts, Charles?
Yeah, that's a great point, Richard. And of course, many people look at gold as in a ratio with, say, housing or equities. And so I've seen charts around where, priced in gold, it took the same number of ounces of gold to buy the median home price in the past as it does now. So that, in other words, if you'd held on to gold, you'd be using about the same number of ounces to buy a house today, even though the nominal price of the house has soared. But Richard, you and your team created a lot of great charts and data here about what portfolios survived the 70s intact. In other words, with no loss of purchasing power, no loss of capital, or even some modest gains, as opposed to those that lost like 70%. So maybe you can cover, the constitution of a portfolio that does well in a stagflationary environment.
Meet the Cedar Owl, a new economics and finance publication with a focus on environmentalism. We combine the Austrian School of Economics and market environmentalism principles for investing in a sustainable future. Follow the link in the description to get to know the Cedar Owl better, understand our values, our mission, exactly where we're coming from, and the type of content that we release on a cyclical basis every Thursday. Join us in targeting outperforming portfolio returns while making a positive impact on society and the environment through technology. Subscribe now for weekly insights, investment articles, and exclusive content.
Yeah, that's a good question. So, trying to see what lessons could be had from the 1966 to 1982 period, with the understanding, history doesn't necessarily repeat, but in many cases it does rhyme. And so this is one chart here where one lesson is to look for dividend-paying equities, value equities that are paying decent dividends to try to hold some of that value. We also looked at other elements. In particular, we referred to the most advice that we follow is having what do we think best insights and investment ideas globally. So one of those 10 is Dr. Mark Farber, whom we do a lot of podcast interviews on our media partner. And so what Mark has been saying is similar to what we're saying, where you could get and more likely get an asset deflation in real terms. So not necessarily a nominal term. So again, the 1966 to 82 phenomenon. And so if we delve down to what happened, again, during the 70s, there was outperformance in gold, hard assets, commodities, value, equities. So these are some additional lessons. What assets make sense from a hard assets perspective, and we'll put together some list on that as well that could be downloaded. But yeah, so this is the lessons of the 70s. Now there is some interesting notes as well. So the phenomenon that we had, like in the dot-com boom, where we had the Mag 3 at that time. It was Cisco, Lucent, Nortel, and they were they were similar to today, the Mag 7, Mag 7 being like the Nvidias and the Apples and the Googles. And so the phenomenon is very similar, where we actually had a nominal fall as well as a real terms fall in prices. Your thoughts on that, Charles?
Yeah, exactly, Richard. And so when we talk about the everything bubble, of course, the arguments being made are that, in terms of earnings growth and so on, profit margin growth, that these valuations are rational. But that historically is not actually supported. In other words, at extreme overvaluations, nothing grows to the sky, and the larger corporation gets, right, the larger its revenues, and then it becomes much harder to grow at the same rate and to expand margins. And so these companies, once they get into the multi-billion-dollar range or trillion-dollar range as we are in now, it becomes basically impossible to grow revenues at the same rate that you did a couple of years before, right? So all of those factors lead to a recognition that the growth rate is going to decline simply from the size, the scale of the corporation, and then that's going to hit the valuation. And of course, the other factor, which I think you guys mentioned too, is there's a speculative sort of mania or speculative fever that rises in a long bull market. And so we can go back and see that RCA, for example, in the 1920s, radio, was like a speculative frenzy, right? And that was contributed to the crash in 29. And then there was a speculative frenzy in semiconductors, telecom, internet companies, et cetera, in the dot-com era. And then that, of course, led to the crash in in 2001 to 2003. And so it's fairly apparent that the Mag 7 is reaching, like the concentration of the market in these few stocks is very similar to what we saw at these peaks in 1929 and to March 2000. So there's that element. And I think we can also, we need to kind of look at how inflation and deflation might be different now, as opposed to the situation in the 70s that we were referring to. So back in that era, 50 years ago, debt levels in corporations, households, and the governments were considerably lower, right? And so debt levels were lower. Globally, the baby boom was entering its peak earning and family formation years, buying houses, starting businesses, and becoming productive, right? So there was this demographic boom, if you will. And then we had a lot of different technologies that were maturing and adding to productivity. And this would be the basic computing, mini computers, and then personal, computers in the 80s, and then the internet kicked in the 90s. And so we had real leverage here in terms of boosting productivity across the entire global economy. Now, compare that to now we have extremely high debt levels, 350% of GDP globally, very high household, corporate, and government debt. We have the AI boom, but AI as the equivalent productivity, that's still an unknown. That's what people are hoping for, but that's unproven, right? So we don't know. It could very well be that the tremendous money being poured into AI will yield poor results. So we don't know about that. And then the other factor that's very different is, for the last 30 years, China has been a tremendous tailwind to the global economy in several ways. One, of course, it opened gigantic new markets for other countries' products and services, and it exported deflation by lowering the cost of goods and services, by introducing a very productive, low-cost workforce in the hundreds of millions. That kind of offset all the inflation that we would have had without China's exporting deflation, because, of course, the developed world was busy printing money and creating credit and liquidity at a vast scale. And normally that would have been inflationary, but all of those inflationary pressures were offset by China. Now China's has its own sort of middle income crisis, if you will, as a developed country. Its economy now has its own issues, and so it's no longer able to sort of save the rest of the global economy from inflation and these other pressures from inflationary factors, such as geopolitical tensions, tariff, trade wars, and other possible sources of scarcity, supply chain disruption from warfare and weather, et cetera, et cetera. So I wanted to kind of point out that it seems to me the argument can be made that inflationary pressures are now embedded in a way that they were embedded in the 70s, and this is why central banks were unable to bail out the global economies by dropping interest rates to zero, like the Fed did in the post-2009 era. That's not going to be, there's not going to be any way to save the global economy, because inflation is now embedded for geopolitical and other reasons. So that means, I think we can kind of summarize that by just saying that the systemic risks to the global economy are much higher now than they were 50 years ago or 15 years ago in the wake of the 2008-2009 global financial crisis. So if anything, looking back at the 70s might be looking back on a much more stable, less risky environment than we have today.
Yeah, absolutely. It's a much different time now and worse in many respects. And the inflation and being embedded is I think also spot on, Charles, because the idea is on financial repression. Um, is of using financial repression to reduce the burden of the government debt and the private debt, all the public debt and the private debt together, by essentially keeping inflation at a relatively high level for a relatively long period of time at the same time. So if you do the math, 4% inflation per year at 10 years reduces the burden of debt by one half. So if you have a higher level of inflation, you could reduce the burden a bit faster or more, as the case may be, to a greater extent, less than half, let's say, high level, greater than 4%. And maybe for 10 years or even longer than 10 years, you're going to reduce the burden significantly of that debt, because essentially with inflation, it becomes easier to pay that debt, with dollars of currency units that are reduced in purchasing power or through inflation. So that actually is very consistent with what is likely to happen, because basically we're at a point where the debt has become unsustainable. Servicing costs are through the roof, and at all levels, public and private. And so there needs to be this reducing of the burden of debt, and it's most likely, as it has done in history, to be reduced through inflation. And so that would lend credence to this rhyming of 1966 to 1982. Your thoughts, Joe?
Yeah, correct. Absolutely. And I would just add that what's different now is if we look at what the central banks did in terms of financial repression post global financial crisis, 2008, 2009, what have they done for the 15 years, after that, prior to the COVID situation? Well, the central banks lowered their interest rates, pushed the bond yields towards zero. So that was very stimulative in terms of monetary policy, and boosted their balance sheets, bought mortgage-backed securities, did a huge amount of monetary stimulus. Then on the fiscal side, the governments were borrowing and spending freely to stimulate spending, right? Bringing demand forward and so on. Well, neither of these is going to be possible if as you say, inflation is embedded at 4%. You're not going to be able to stimulate the economy with fiscal stimulus, because then you're going to make inflation so high that then the public will rebel. In other words, like when we saw inflation go to 7, 8, 9%, then that's not politically feasible, nor is it a positive for the economy, because everybody's losing ground, right? So you're sort of limited in the fiscal stimulus, and then the central banks can't drop bond yields to zero with 4% inflation. No one's going to buy the bonds, and they won't be able to use their monetary financial repression to sort of stimulate the economy. So if we get a global slowdown or global recession, this is another sort of pattern I'm suggesting could follow the 1970s, where it was stagflation, right? Wages, were going up because people were falling behind on high inflation. There was geopolitical crises that led to scarcities of oil and these kinds of things that are present again. And so if you get what I think we're entering a position where all the tricks that worked, the financial repression that worked in the last 15 years is now not going to work. It's going to make the problem worse, right? So that's why we're sort of discussing that the 1970s was not only a testing ground for nominal, stocks recovering nominally, but having lost in real terms 2/3 of their value. We're also looking at a stagflationary period where the economy just sort of stumbles along at either low growth or no growth or a negative growth, and then the central banks and governments unable to stimulate their way out of that stagflation.
Yeah, absolutely. And so, looking to try to end on a positive note, notwithstanding it's going to be very difficult in this environment to maintain, standards of living. So one thing is the idea from history of looking at these type of investment asset classes and dividend-paying equities, hard assets, emphasizing that is what we're looking at. Do you have other suggestions other than that, especially from the many books that you've written on how to be able to cope and survive in this type of environment that might be helpful?
Well, thank you for that question, Richard. And I think you've the article that you posted presents a very good portfolio that's diversified. In other words, if somebody has some precious metals, they have some dividend-paying stocks like utilities or energy companies, and then maybe short-term treasury bonds that are paying equivalent at least to inflation, then you'll at least preserve your capital, which is going to be the big win in stagflationary periods. If you can avoid losing a half to 2/3 of your capital, then you're a winner, right? If you come out with capital preservation. Beyond that, I would I tend to counsel or recommend looking at utility value and businesses and assets that you own and personally control, as opposed to, like, say, shares in a company to pay dividends. That there's something to be said for that. But if you, like, say, own your house and you rent out part of it, or you have a duplex and you're renting out part of your own property, then you control everything: who your tenant or neighbor is going to be, what you're going to charge. You get to write off your expenses on your taxes. So there's a lot of benefits to owning businesses or enterprises or assets that create some value. And then in terms of, like, what is the value? Well, of course, it's set by the market, but as we're talking about, the market value can be deceptive because it's like, what's the real value? So if you own your house free and clear, for example, it's going to provide you shelter. Its core utility value is you have a place to live that you control, you own, and you know how much it's going to cost you. And so whether the price is $1.5 million or 200,000, depending on what fluctuations there are in currencies and real and nominal value, it doesn't really matter because you've got that core utility. And so in the same way, if you have income streams from an enterprise you own and control, the valuation may rise and fall nominally, but the core utility value of that asset is always going to be the same, in the sense that it's going to be creating income and have value for that reason. So yeah, maybe in addition, we can mix in that ownership of income producing assets that you physically own and control, like an enterprise or a property.
Yeah, that sounds like great ideas and suggestions. Well, thank you so much, Charles. It's been a great, insightful discussion. How can our listeners and viewers learn more about your work?
Yeah, please visit me at charleshughsmith.substack.com or at of2minds.com. Thank you very much, Richard.
Yeah, thank you so much, Charles.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.